Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in today's video, we're discussing one big mistake that can eat away at your annuity profits. And this video was inspired by a question left on a recent annuity video we shot. And a viewer named Diane asked, if a younger person, 35 years old, buys a 5-year MYGA with non-qualified funds, are there any tax implications apart from the taxes to be paid at the maturity on the accumulated interest from the 5 years?
Yeah, that's a great question, actually. And the answer, Diane, is it depends. Let me explain real quick what the basics, and then I'll dive into the answer. First of all, an annuity is a tax-deferred account, okay? This means you don't pay taxes until you start to withdraw from it,
Right.
okay? The withdrawals are counted as income in the eyes of IRS, and taxes will be due on a last in, first out basis. So it's called LIFO, okay? All earnings must come out first and be taxed. Now, let's go back to the question. Diane asked if a younger person, 35 years old, buys a 5-year MYGA with non-qualified funds. That means not IRA funds, right? Is there any additional tax implications apart from the taxes to be paid at the maturity on the accumulated answer? And the answer, it depends on if they withdraw the funds or not. Okay.
Okay.
So this younger person would have an additional tax implication if they withdrew the account prior to the age of 59 and a half. This is where our number one annuity mistake comes into play, especially if using non-qualified funds and if you're planning on withdrawing the funds prior to age 59 and a half. You lose a lot of the money that you've earned.
Okay.
So let me explain this into detail. Since the account is tax deferred, okay, this means that at some later date, the IRS will want their tax money, right?
Yes.
Doesn't this sound like an IRA?
Yes.
It does sound like it. IRS says that a tax deferred, or sometimes called tax favored account, you have to leave them funds till age 59 and a half or pay a 10% pre-59 and a half penalty.
So, but the question is about non-qualified funds. If the 5-year MYGA was purchased with non-qualified funds, how is it seen as qualified by the IRS?
This is one of them little gotchas, Michelle, because you're going into a tax deferred or tax favored account. That's what annuities are. Okay.
Got it.
Which the IRS now considers to be just like a retirement account.
Qualified. Okay.
Yes. Okay. In this case, Michelle, the earnings would not be subject to the 10% penalty from the IRS, just the earnings would be, not the principal. The principal is non-qualified still. Don't that sound almost like a Roth IRA? It does, don't it? Okay. So same example. Okay.
So can you give us an example of like how this might play out using the 35-year-old in the question that Diane asked, right? Like get really specific, like play this out for us. Okay,
perfect. This is the best way to do it. This is the best way to understand it. Let's say John is 35 years old and he purchased a $25,000 5-year MYGA from XYZ Insurance Company. Okay. Let's say XYZ Insurance Company gives them 4% interest for the 5 years. Okay.
Right.
At the end of the term, Michelle, John is now 40 years old and the account is now worth $30,416.32.
All right.
He withdraws all the funds. The next year, he receives a 1099 for the same amount, the $30,416.32. But line 2 says the taxable amount is only $5,416.32. His earnings.
Right. Okay? Sure.
So if he's in the 15% tax bracket, he'll pay taxes on this amount as normal income.
Normal income.
Yes. So $812.45 would be his taxes. But then he's going to pay a 10% IRS penalty because he's 40. He's under age 49
under
and a half.
59 and a half.
So there's an additional $541.63 in penalties. Between taxes and penalties, John's going to pay $1,354.08 from his earnings of $5,400. This brings his profit down to $4,062.24, and his effective yield now around 3.05%, not 4%.
Okay. So real quick, I have a question. I see how this is the one mistake that can eat away at annuity profits real quick, right?
Right.
What happens if John rolls over or opens up a new MYGA or does something with it in what the IRS considers to be a tax deferred account? Does then he would have to then pay the interest on the earnings, but not that 10% penalty?
No.
Ew.
And if he does it the correct way.
Oh,
Okay. Okay. So let's say this is a great scenario. What if John says, this MYGA's done. I've got to cash it out. No, you've got an option of renewing it with that company. Well, if you renew it with that company, it continues for another 5 years, right?
Right.
Or if you roll it to another one that's paying higher interest, as long as it's qualified transfer, direct transfer from one to the other, using what's called a 1035 exchange in the annuity world, there's no taxes or penalties. It's so deferring that contract until retirement. So,
all right, got it. Okay, perfect. Well, thank you.
Great question, though.
Yeah. So
it is a huge mistake.
I mean, it is. I was going to say it's a big, big one, right?
It is, especially if you're planning on withdrawing the funds prior to age 59 and a half. But here's my issue with this. You can blame the industry for not speaking about this very often. Advisors like myself and companies that sell annuities always use their regulatory language in their ads that says, please consult your tax advisor as we do not provide tax advice.
Total crap.
I'm sorry. Crap. You're giving tax advice when you set up this account, especially in this situation of using non-qualified funds. If I have a client walk in my front door and says, I've got $25,000, if John walked in my front door, I want to buy a MYGA. I'm 35 years old. As a fiduciary, my job is to explain that to him.
Sure.
So there we go.
What's amazing is that it doesn't seem like you can do these investments. You really need to have a conversation about the taxes because the two go hand in hand. That's why you're making a decision to put it in a specific investment vehicle in the first place. It's not just about how much money I can earn, but what are the tax implications if A happens, if B happens, if C happens, and running all those scenarios.
Don't you need to know that?
Yeah.
It's just common sense. It should be part of your practice. If you're out there educating and teaching consumers what to do with their retirement plans, you better know taxes.
Yeah,
I'm sorry.
Absolutely. Amen. All right. On that note, we'll wrap it up. Thank you to everyone who watched. If you like the content of this video, hit that like button, help us grow this channel. Do not forget to subscribe. We've also put some top-rated or some of our top annuity videos in the link below in the description below the video, I should say.
Awesome.
And don't forget to subscribe. So thank you, Brian. And
thanks Diane.
Thanks, Diane, thank you, Diane. Absolutely. You got questions, leave them below. We're always making videos answering them.
Definitely. Thanks, Michelle.
Right.
Thanks, everyone.
Bye.
Have a great day.